We're back. The Dow remains lower as investors turn their attention to the debt ceiling in that meeting between congressional leaders and the president we just showed you at the White House. Tech remains a bright spot, and our next guest expects it to stay that way. Let's bring in Treasury Partners CIO Rich Saperstein. He's here with me at Post 9. He's one of Barron's top-rated financial advisors, so we need your advice, especially right now. Welcome back.
Thank you.
Are you still sitting on a pile of cash?
Yes, we are.
Why? Why are you still so negative in the market?
Well, we're not exactly on cash. All the cash was moved into bonds, as we spoke about last September. But if you look at the facts on the ground right now, you have M2 negative for 6 months.
Money supply.
Right. Consumer spending is down. Availability of credit is tightening. Leading economic indicators that prospectively tell what's going on, they're dropping. So we expect the economy to slow in the second half of the year.
I mean, it's been much more resilient than people have thought. I would assume you included. The consumer, even though retail sales were slowing, they're still pretty good. Employment is pretty good.
Those are the two positives, but Home Depot the report this morning will clearly refute that.
Yeah, but I mean, there were other factors going on in there, too. And even if we throw up Home Depot shares, they've come off the mat of where they were. And there were some, other extraneous factors that came to play there, too.
But if you look at the first quarter performance, market's up 8%, but the equal weight is flat. So it's really been driven by big tech, which is the largest component of the S&P on a cap-weighted basis. So the tape really isn't trading too well.
This has become the issue of the moment. The top-heavy market, right? The mega caps are pulling the weight of everybody else. So what? So what? Why is that such a big deal?
Well, we're overweight big tech, so that plus our other asset-allocated parts of the portfolio. So we're okay with that. We don't have a problem with big tech pulling the market.
No, but people cite that as one of the reasons to build the bearish case. Oh, breadth is terrible. It's so narrow. So what? Why does that matter so much?
No, we're building a cautious take, not because tech is leading the market, but rather because the fundamentals are deteriorating. We had 15 years of free money, quantitative easing, as well as a $5 trillion fiscal push that we're taking is a big lag to burn that off. So we're wringing out those excesses. Figure second half of the year is when we'll start seeing a slowdown.
You think the Fed's done?
Yeah.
So they're not raising any more?
I don't think so, but keep in mind, there's a lot of conjecture about the resolution of the debt ceiling. The debt ceiling will result in a trifecta of tightening. It'll supercharge QT. Here's how it works. Yellen's been burning down the Treasury General account, the TGA, in not issuing treasuries. Powell's still doing QT, so the offset has been pretty constant if you take away what Powell did for the banking crisis drama. So once the debt ceiling is resolved, which maybe we'll get it, okay, who knows, Yellen's going to have to rebuild her checking account. So it's estimated that she'll be issuing an extra $600 billion worth of treasuries in the second half of the year. That's a tightening. Combine that with QT, and then add that to the banking drama that has resulted in bank willingness to lend decreasing. It's going to be some real tightening in the second half of the year.
So your base case then must be recession?
Slowing. Can't tell whether you define it as a recession or not, but
I mean, if it's just slowing, hasn't the market priced in slowing?
No, not
it hasn't priced in slowing.
No. Look, we did $53 in S&P earnings Q1. So the estimate for the full year is 220. We don't think it's happening. If you put 18 and a half times earnings right now on 220 is where the market is now. If it goes to 210, it's 19 and a half times. If it goes to 200, it's 20 and a half times. Either way, where is the market going in an environment where rates are 500 basis points higher?
From nothing.
Yeah.
They're 500 basis points from nothing. Do you think yields have peaked?
Yeah, they have. That's why last fall we spoke about aggressively extending maturities. And that leads to another conclusion. A lot of people are buying, 2, 3, 4, 5, 6 month treasuries thinking they're going to get 5%. It's great. Well, we would avoid that and we would extend out much further. The economy slows. They're going to have huge reinvestment risk on those, beautiful 5.1% 3 and 6 month treasuries.
So you like the long end, like Gunlock, like 30?
Oh, yeah. Well, we've been buying 10-year corporates. We've been buying long callable municipals. The FDIC right now is auctioning off billions of dollars of municipals right now every single week.
You think the Fed cuts this year?
No, not at all.
What happens when they do? Is that bullish or not?
It will be, depending on where things are. So here's how I look at it. And this is where the market, I don't think, got the memo. If the Fed cuts, that means that we're slowing dramatically or significantly, or there's a tail risk event, neither of which are positive for stocks.
But see, people say that, and it may not be positive for that moment, but I have other people saying that cuts are always bullish.
They are in the short run. But the reason for the cut is because the economy is slowing.
In the long run?
No, in the short run. Like the market, the fanfare of the markets will be, the Fed's cutting, we're going to go up. But let's face the reality of stocks follow earnings. Slowing economy will result in lower earnings. All right, go back 10 years. S&P did $100 in earnings, sold it 13 to 14 times. Right now, the estimate is for 220 this year, and we're at 18 and a half times. So we've had multiple expansion in the last 10 years, and I don't think we're going to get 220, Scott.
Does the wine you make taste better than your view of the market?
Absolutely.
All right.
Vigna Andrico.
All right, we'll leave it there. Rich Saperstein, thank you.
Thank you.
All right, we'll talk to you soon. Up next.